Hello everyone, welcome to Oliveboard. I welcome you all to our deep dive into the financial tug of war between the RBI and the Finance Ministry. So let's have a discussion regarding the RBI's contingency risk buffer dilemma. Before starting the video, I would like to tell you that if you are preparing for your RBI Grade B examination 2025, you can check out our course and you can start your preparation with Team Oliveboard. You can also download this particular PDF of this YouTube session from our application. You can also download the previous year questions and you can start practicing them. Apart from that, on every Wednesday 8 PM I take session on PYQs, just like I did this week on the PYQ 2024. We'll be having discussion in the next week as well related to the 2023 PYQ. Okay, so stay tuned. Now at the heart of this debate lies the contingency risk buffer, which we call it CRB in the short form, and that's a crucial component. Let's have a discussion regarding what CRB, that is contingency risk buffer, is all about. So as the name says it all, contingency risk. What do you guys mean by contingency risk? Because of some contingent event which we are not sure of as of now, that's why it's contingent event, there is a risk, right? And what we are trying to do here, because of that contingent risk which is there, we are trying to create a buffer for eliminating that contingent risk or for neutralizing that contingent risk. So CRB is nothing but a financial safeguard maintained by the central bank, Reserve Bank of India, to cover the unforeseen risk. जो risk मुझे नहीं पता, that can come up in the near future, unforeseen risk. It can be related to economic shocks or currency volatility or even financial crisis. So that's why RBI is creating contingency risk buffer every year from the revenue it is earning, right? So this is established under the Economic Capital Framework, another important terminology, ECF, Economic Capital Framework, which is recommended by Bimal Jalan Committee in 2019. Okay, so ECF framework was recommended by Bimal Jalan Committee in 2019. This CRB is ranging between 5.5% to 6.5%. Okay, so the range is 5.5% to 6.5% of the RBI's balance sheet. However, the proposal RBI making this year is for 7.5%. Okay, this year's proposal is 7.5%, yet things are yet to be finalized as of now. Okay, now let's try to first understand what ECF is all about, Economic Capital Framework. So Economic Capital Framework is nothing but a structured mechanism that is adopted by the RBI for appropriate level of risk provision and the surplus that can be transferred to the Government of India. We all know that Government of India is having the shareholding of RBI. So whatever RBI is earning is transferring as dividend to the Government of India. Now dividend decisions are an important decisions. Let's suppose RBI earns 100 rupee. So how much to declare as dividend to the Government of India and how much to retain is a very crucial decision, right? And that's what we take in Economic Capital Framework. This decision we take in Economic Capital Framework. It's a structured framework adopted by the RBI to determine the appropriate level of risk provision, how much risk provision to make, how much money to retain, and how much money to distribute as surplus to the Government of India as dividend, right? What is the objective? To strike a balance. Look, there should be a balance, right? You cannot distribute the entire 100 rupee to the Government of India. Ki lo sab 100 rupee. Nahi. That doesn't work in the long run. You need to create a certain buffer as well to absorb any kind of contingent shock, right? So here the objective is to strike a balance between maintaining adequate financial buffers for monetary and financial stability and ensuring prudent surplus distribution as well, so that government भी नाराज ना, उनको अच्छा खासा surplus dividend मिल जाए उनकी activities के लिए. At the same time, you are able to retain a good amount of buffer for monetary and financial stability, right? So in case of bad times, right, you are able to use that buffer to get out of that bad time. Now how this particular thing is created. So how the RBI earns money, basically it lends to the bank, earns repo rate, right? Trading of government bonds, so they buy and sell government bonds as well. Seigniorage is also earning for RBI, right? Let's suppose they created a 500 rupee note in 3 and 4 rupee, 3 or 4 rupee, and the value is still 500, right? So this difference is nothing but seigniorage. Then RBI is holding foreign assets as well, like US dollar, other currencies, US treasury bonds, right? Gold, silver. So that the value is also appreciating, right, day by day. So that's how also RBI is earning a huge amount of unrealized gain out of it. And there are other sources as well that they are acting as agent for government as well, right? They are taking commissions as well for the work and a lot of things, right? A lot of earnings. So this is how RBI earns money. This is the income. And obviously there are a lot of expenses as well, like paying salaries, doing multiple activities around the banking sector, right? So here comes the surplus. So what happens is we don't call it profit in case of not-for-profit organization, we call it as surplus. Because RBI is not operating for making profit, right? So I can say that this surplus, one part you will distribute as dividend to the government of India, and another part you will be retaining in your business, right, as contingent risk buffer, right? So the range is 5.5 to 6.5. Now they have proposed it to 7.5%. And we can see here that there was a 615th meeting of the central board of the RBI. So central board in the RBI basically is for taking crucial decisions like these, right, related to the economic capital framework as of now. So the board has reviewed the economic capital framework of the Reserve Bank of India, right? And they will soon announce the same, like what are the changes in the ECF framework as of now. So if I talk about how much dividend year on year basis they are giving to the government of India as of now, so we can see that the dividend is continuously in increasing trend only. So in the last financial year 2024, they have announced 2.1 lakh crore dividend, and that's huge, right? That's huge, right? So this much dividend RBI is paying to the government of India. And what is the expectation for the financial year 2025? The expectation is a 50% hike on the previous year figure, right? So the Reserve Bank of India is expected to transfer a record surplus payout as of now of 3 lakh crore to the government for financial year 2025. This is close to 50% increase, right? Approximately 2 lakh crore we have distributed in the last year, and 50% of that is 1 lakh crore. So total 2 lakh crore plus 1 lakh crore is now 3 lakh crore approximately. They will soon announce it also, right? Why there is such a big payout? Because higher forex income. We all know that RBI is keeping forex reserves, and they have gained a lot of money because of that increase in the forex reserves, right? So the major reason is also elevated US treasury yields as well. RBI is holding US treasury bonds, and the yields are quite lucrative. Okay. Review of capital economic capital framework, as we discussed that in the meeting, the discussion is being done related to economic capital framework, right? So why they are paying so much dividend to the government and how the government is eventually using it? So obviously there is a lot of fiscal deficit. We all know that India is a net importer globally, right? If I talk about all the merchandise and service exports, then we are net importers. So there is a fiscal deficit that we need to fund, right? So it reduces the fiscal deficit for the government. It helps in aiding relaxing the fiscal deficit as of now. Enhances the revenue generation. That's a major source. That's a non-tax revenue for the government. Obviously the government is earning via collecting taxes, and this thing is enhancing the revenue generation, right? Next is lowers the government borrowing. Obviously the government has to borrow a lot of funds, However, if they are receiving such big amount of surplus from RBI, so that reduces the additional borrowing load, reduces the borrowing cost. If they borrow lower amount of money, definitely the interest they will be paying is much lower. Keep the interest rate in check, and falling the sovereign yield influence the broad market rates, making borrowing cheaper for the business as well as for the household. So these are the significance of RBI's transfer to the government of India. That's how the government of India is using this surplus, right? If I talk about the RBI's perspective, definitely they advocate for higher CRB. Why? Because they want to absorb any kind of contingent shock which might come in the near future. It can be related to geopolitical tensions, it can be related to financial sector vulnerability, right? So they want to create a larger buffer. However, if I talk about the finance ministry perspective, the government of India perspective, they want to lower the CRB and they want to maximize their surplus, because definitely they need money to fund the fiscal deficit, they need money to lower their borrowing cost and all, right? What are the implications basically of CRB adjustment? Basically a higher CRB, let's suppose the CRB is higher. I told you that surplus, if we make two parts of the surplus, let's suppose 100 rupees the surplus. If I keep the CRB at 10 rupees, let's suppose at a higher end, definitely the dividend that we will be paying to the government will be less. However, if I create the CRB at 5, definitely will be paying 95 as dividend to the government. So higher CRB, RBI is forcing for higher CRB, I can say. This reduces the surplus available to the government use, potentially leading to the increased borrowing, right? It may also tighten the liquidity in the banking system. However, if I talk about lower CRB, the government of India is forcing on the lower CRB. Why? Because they want more of dividend so that they can contribute to the nation, right? So what's your opinion, guys? Tell me in the comment section, what do you think should be the correct approach, higher CRB or lower CRB, right? Do let me know in the comment section. And thank you so much for watching this video. मिलते हैं किसी और वीडियो के अंदर. टेक केयर, बाय बाय.